Hello and welcome to Business Viability Tools. This is the fourth step of our six-step framework that we are following through to develop our conversations around business viability. So in the fourth step, we now get into the fun stuff of break even. We're going to talk about in this session what is break even. We'll talk about how to calculate the break even point and then convert it to the number of items of things that we need to sell. In that. So there's a little bit of technical jargon in this particular session. And the good thing is once we get through and we can understand how the calculations are made and we can put that into our business viability tool, it'll make it a lot easier and get the spreadsheet to do the work for us. So essentially really what is break even? It's the point at which the business is neither making a profit nor a loss, which is a good thing. It shows us that there's enough sales coming in to cover all of the fixed and the variable costs or direct costs. So we've been talking a little bit about that in the last couple of sessions. So we know that there's enough money coming in to keep the business afloat. The good thing about what we do is business viability is obviously considering the personal income as a fixed expense in our considerations for the break-even point. So the official wording is, as you can see on the screen there, the break-even point in sales dollars can be calculated by dividing a company's fixed expenses by the company's contribution margin ratio. The contribution margin is a sales minus variable expenses. When the contribution margin is expressed as a percentage, it's referred to as the contribution margin ratio. So there's a lot of words there, and it introduces some technical terms around contribution ratios and things like that. For the time being, I wouldn't worry about that. It's not something that's too important to be worrying about. In the next slide, we'll show you how to do the calculations anyway. So to give you an example there, so break-even sales is my fixed expenses, and it's divided by the sales price minus direct cost, and that's divided by the sale price as well. As we go through. So just to give you an example there, we use our example that we've been using on our slides so far. Is we've had in our examples we've got 75,592 is our total fixed expenses. We're selling our $80 trainee coaching product or service, and that had a $40 direct cost. So I wanted to use something that had a direct cost as part of that calculation, so you can see how that all comes together. So in the last line there, it talks about the fixed expenses being on the top, and it's divided by the $80 minus the 40 divided by 80, and that's going to give us the contribution margin, which is the 0.5 that you see at the bottom of the screen there. So if we've got $75,000 or $76,000 that we need to cover in fixed expenses, we know we make, it basically is saying that we make about 50% gross profit on our that particular product. So what it means is that we need to generate $151,000 and $184 of sales to cover the cost of our trainee coach, as well as cover the rest of the business expenses that we want to cover off in that 12-month period. So that's the total number of dollar sales. To a lot of the break-even calculators that you find online will always be in terms of break-even sales in dollar terms. So as you're probably looking at going, well, what does 151,000 mean? I'm agreeing with you completely. What's important to me is the working out how many does that equate to? How many sessions do we need to run in 12 months with my trainee coach so that we could actually run the business completely from that? So we convert it to the number of units. So the number of units is my total of break-even sales divided by the sale price of that one unit or one of those units. So we know that the break-even sales was from the previous screen $151,184. We divide it by $80, which means we need to sell 1,890 units to actually break even. So as you can see there, that's how we work out how many hours we need to have our trainee coach working for. To show you on the example here, we've got the screenshot of what the business viability tool looks like in terms of the products that we've entered in, as we can see from our last session. And what I've done there is added a new column which is called break even. And you can see there for our trainee coaching session, we need to break even at 1,889.8 hours. So it's important to see here how we can, and that would be an example of if that was our only particular product or only service that we're offering, I'd need to generate 1,890 hours of a trainee to be coaching clients for a whole year so that we could all make some money out of that. So that's what the break-even column there is for. So you can see coaching session there. If that was my only service that I was offering, I'd need to offer 755 hours in a 12-month period. If that was just me doing the coaching sessions with no other direct cost involved. And the same with coffees. You can see there that we'd actually need to make about 22 or just over 22,000 coffees in 12 months to generate enough income to cover that $75,000 of, or nearly $76,000 of fixed expenses for that as well. All right, we can see there widgets, obviously, if we sell them for 500, we're making a couple $100 on each one. So to make it a viable business, we'd need to find a way to try and sell 377 of those widgets in that 12-month period. So that would be all that. In the next session that we're going to talk about, we'll talk about setting targets, and we'll have a look at how we can then use this break-even point to set some targets, especially when we do have multiple products across our business. So our 6-step framework was paying yourself first, understand your fixed business expenses, define the products and services. We've just done the break-even. Next session, we talk about setting targets and our sales and marketing links coming up in the last module. All right, so I look forward to seeing you then, and we'll talk about setting targets.